Hey everybody, welcome to Trading Capital. It is April 5th. Let's jump right into the charts. I think the biggest talking point that we should touch on today is the NASDAQ. This price action that we witnessed today was completely what here at Trading Capital we wanted to see and how we were positioned to capitalize. We saw a major bearish reversal. So let's start off with yesterday's price action. Here you gapped up, faded in the pre-market, and then just started rallying all day long yesterday until you made a high and closed substantially higher. And then today the selling just continued and continued and continued and continued all day long. And what's really interesting about the selling that occurred is that it happened again on light volume. So this is why we were very suspect and cautious with trading and taking positions in this market, and certainly not going long on certain volume indicators that we were noticing red flags in. So on a technical basis, since you reversed all of yesterday's 2.07% gain by closing down 2.22%, you've done what's called a bearish reversal. So not only is this reversal near the highs, you would have liked to see it right at the highs, but it's near the highs, and it completely erased yesterday's rally. So right now on the week, the bears have taken control slightly. You're almost flat on this week, but the fact that you witnessed a big bearish reversal, and which negates all of yesterday's gains, is certainly a bearish indicator. There's a couple key trend lines now that we're watching in the short term. So since we have now attacked the lower pivot zone here, it's likely that we're going to test it again at some point. And I have two trend lines going across here. There's multiple pivots. They're very close in proximity, so either or you can really use as your analysis. We're going to have both on the chart just to show you why it's important. So essentially now we're creating this, what looks to be a topping pattern going on. And this is now your trend line of support that you want to hold. If you start breaking this trend line, there's a lot more downside for the overall index. Let's just flip to the daily chart so we can get a good sense as to where our next support levels are coming in. Right now, you can clearly see on the NASDAQ, we have failed now twice at confirming and closing above the 200-day moving average. And we failed today with a complete bearish reversal. We tagged it and just bounced right off of that 200-day. And that shows that the markets are not ready to keep rallying, certainly after this extended move. The probabilities dictate that we see a more of a controlled pullback, but what we witnessed today wasn't a controlled selling. That was some deep, hard selling that just was relentless all day long. So it's certainly you have to be aware of the type of selling, the type of candle that it forms at the end of the close on the day, the volume count which occurred in terms of the selling, and what stocks were hit. And it's pretty fantastic when you position yourself on the right side of the big market downturns. So looking here, we have a major pivot high here. That's ultimately going to be your next level of support. If we break this pivot, I think that's your next area that you test right away. If you happen to get through this pivot zone, then you have this one as your next zone of support. Obviously, if you get through that, you go down to test your double bottom zone, which it would definitely have some support there, but I ultimately do think you break that level of support and start heading low on the charts. My next major bounce level that I have anticipated, and now these levels can change based off of how the price action gets in there, whether there's some sort of economic collapse or news or catalyst, but there's a massive gap fill right around the 274 mark and change. That is going to be a huge level of support that I do think we hit maybe over the next 1 to 3 months. I definitely think the markets head into that territory. There's going to be bounces along the way, but I think that's going to be your next biggest bounce, something that potentially like this could happen again. Not to this extreme, because as you get low on the chart, the bounces don't have as much force. But nonetheless, I do think you still can capitalize not by catching the falling knife per se, but by positioning yourself correctly for oversold stocks and knowing which levels of support based off of certain, time count practices, volume indicators, and how the price action has ultimately bled into a certain area. Let's jump into the spider chart here. The spiders had an interesting price action. Again, you pretty much saw all selling all day long with a few intraday bounces. Ultimately, the key level broke that I was watching, which is this trend line, connects this pivot low to this pivot low, and now you broke below that. But notice how at the end of the day you were saved. You bounced right back onto that trend line of support, and it looks like now in the after hours, the final orders have come in. You've actually closed back below that. So that's a bit of a bearish sign. I was analyzing this chart before I started this video, and I was noticing that now you would want to see the bullish trend continue above this trend line. That would be bullish, but a daily close below this trend line now sets up confirmation tomorrow. And if we close below that trend line, ultimately I do think you head to this gap fill fairly soon, within a day or two, on a technical basis, since the damage is done, which means there's still a decent amount of selling that will occur, which is another 1.5% down from current levels. Once you break that gap fill, and before I go on to the gap again, one of the reasons why this is such a crucial level of support is you have on this intraday basis is this head and shoulders topping formation. It's one of the classic patterns most people know. You just have to know when the pattern triggers, because when you look at the chart and you notice a head and shoulders pattern, it's about a 60 to 70% probability of it actually triggering. And when it does trigger the pattern, when it triggers by having a daily close below the neckline of the pattern, then it bumps it up to more of a 75% success of completion and more downside. So it does give you a higher probability, and then you factor in the fundamentals, with Brainerd's comments in the markets today saying that the Fed sees a more of a rapid sell-off in the balance sheet. We've seen sell-offs occur in the balance sheet. I don't think the Fed is in a position to do a so-called rapid sell-off. I guess their definition of a rapid sell-off and my definition of a rapid sell-off are probably two different things. When you're at 9 trillion and you've blown that up in 2 years by 4 trillion, or 5 trillion, you've more than doubled your balance sheet. You essentially, if you're not reducing the balance sheet in the numbers that you were inflating the balance sheet before, then I don't call that a rapid sell-off. So they were inflating the balance sheet for most months up until the final 5 or 6 months where they started tapering. They were inflating the balance sheet, I believe, for 18 months straight at 120 billion a month, which is an exceptional amount of money and liquidity that helped prop up and send these valuations through the roof. And ultimately, now we're dealing with inflation, which was certainly easy to forecast and predict. And it's certainly not going to be transitory. The only way I think it's transitory is if we have a recession that we actually go through, and it's not the Fed doesn't revert back to loose policy. Give it some time, potentially 6 months to 12 months out of 6 to 12 months in terms of recession, I think would do the trick to really start cleansing and putting a dampen on inflation. Let's go to the IWM. The IWM here on a daily basis, you can see again, nasty reversal candle. And what's interesting about this is the damage is technically done. So one could have said you were still consolidating bullishly since you're trading above that high and that low. So you were trading in this range, and it had an attempted breakout, failed, retest back to the failure point, and you just had this massive reversal candle. Now what's interesting about this is you would say that it was bullish consolidation in this channel up until you broke this pivot high. Even though you didn't close below it, you haven't set up confirmation, the technical damage is done. The probabilities dictate now that this pattern is likely to head lower. Obviously, I think the biggest level of support, you'll have some minor support at the 50-day moving average, but I do think you go to test this gap fill down into that region. That gap fill might just also coincide with the top of the channel somewhere in this range once you get there, which is your long-term Russell channel that I do think you eventually get back into, and that'll take you to the pre-COVID highs and then potentially even lower from there. Nothing really new to report on gold. Gold's still having this massive bearish consolidation. You can see the, I'll just draw it here, the big bear flag down there. And then you also have now what looks to be a mini bear flag in there. So it's very interesting to see how the medium-term pattern is bearish, and now the short-term pattern is bearish, which leads to the probabilities that the charts are saying that this pattern is likely to break down sooner rather than later. So I'm expecting potentially a move all the way down to this down-sloping trend line. It could happen within a 2-week period, or maybe even faster if there's some sort of resolution. But you're getting close to what is now support. These are our two original levels of resistance. Now there's support and resistance. So once you break that, I definitely see a bit more downside in gold. What did we do today? We issued an alert to our members to pick up BMY. For those of you who picked up BMY, let me just show you why I picked up BMY. And essentially, if you go onto the weekly basis, what's interesting is you have this long-term trend line going back all the way to the 1999 before the dot-com collapse. You have a pivot high all the way here in September of 2016. And that was really when the tightening period started, and then it ended roughly in 2018, and then the markets bottomed here 2019. So you have these massive pivot high zones, and now look what you're running up into. So the reason I pulled the trigger on this short today is because there's really not that much room left for this to run into major resistance. Now, we did inch into this position. It's only about 1% of our portfolio, so we have tons of room. I'm willing to take that up to between 4 and 5%, just depending on the market dynamics. But 4 to 5% in this name, we have plenty of room to add if it does go higher. If it does breach this trend line, do expect another alert for me to potentially add another 1%, and then we will take the position from there. So again, we look for multiple factors on the charts for why we pull it on a technical basis. So a couple of factors out of the last 17 weeks here. You've had 15 weeks of upside, 2 weeks of downside consolidation in these zones. From this point of consolidation, you've now pretty much had a fully measured move. And when you look at the charts, the reason why technical analysis works is because, again, it's fear and it's greed. And if you notice across many different charts, you'll notice one common theme across charts. When charts move, there's often measured moves that occur multiple times on the chart. So for instance, this measured move down here is going to be very similar to this measured move to here. So stocks like to move in measured moves all the time. So if we take this measured move and just put it from the low of our stock to the high, you can see that we've almost completed a measured move, which is another factor. You have a little bit more to go, which we're more than certainly happy if it goes higher to add to our position, because it's completed a measured move. It's extended. When you look at the RSI, it's been in overbought territory for a couple of weeks now, and you have had this time count that you're approaching into a major long-term resistance trend line. So we do expect a pullback in BMY. Where can we expect a pullback? I think the first area will be in and around here, connecting these multiple trend lines. You can even bring it back into here. So you have lots of support coming in there. From our level, if it was to fall, that would be a nice 6% in the bag that we can easily take off the table. Ultimately, I do think you head even lower than that. That'll just be your first level of support where you could expect a bounce. Where you see this stock particularly move, when it does start to sell, it really starts to sell. And these are weekly candles, so you can see it had 1, 2, 3, 4, 5, 6, 7 weeks of downside before a little bounce, bear flag, and completed the last 3 weeks of selling. So this stock, although it does have big rips to the upside like this measured move and this measured move, it also has massive dumps. So if we were to simply take this measured move to show you, it goes all the way up to this point, we just do another measured move calculation, and this isn't doing any math. This is just simply using trend lines. You can get it a little more sophisticated and technical by incorporating a little bit of math into it, but just for simplicity and the nature, if you take that measured move, that basically puts you down to the 200-day moving average. Obviously, this is rising, so you would definitely have to pierce that, just like on all these occasions here. But that puts you into major support, and that would be a substantial drop from those highs, roughly 27%. So there's major support. You're in a time count. You're overbought. You're extended. The PE is starting to get a little bit out of whack for this particular company, and you're into long-term resistance. And the conditions in terms of the stock market where we think they're heading is lower. This should be dragged down as well. We also added to our Tesla short yesterday. We added around the 1,145, I believe the alert was for. And we didn't, it's not quite a full position that we have, but it's getting awfully close to a full position. And we still have a little bit of room to add more, but ultimately we're not going to add more to this position unless it takes out our previous add level or approaches that double top area again. But interesting price action on Tesla is it had a nice drop today, roughly down 4.73%. Again, you can see it just was consistent selling. You flagged, created a nice bear flag. You broke this flag, triggered the technical pattern, and the damage is now done on the charts, and you're starting to roll over again. The big question is, will Tesla now break this trend line of support? Because you have this choppy topping pattern that is currently in the works. If you trigger this pattern, I'm a firm believer you see a sharp sell-off right down to this gap fill, okay? And the beautiful thing is that 90% of the gaps get filled, and once we fill that gap, we're in the money on the trade. And if you look how extended Tesla still is from that gap zone, the major rally occurred from this move, and you had light volume retail investors propping the markets up since then. But as soon as we fill that gap, which will be a nice 7% down, we'll be in the money on our trade. And I ultimately do think on the daily basis, you come back down to the bottom of this channel again, and eventually breaking that channel. And just look at the power of these parallel lines. So you had your pivot high to pivot high to pivot high, and look at the power of the reversal off of that trend line. Isn't that incredible? We had that on the charts. We executed it flawlessly, not at the exact high, but we were $7 away from the high of that reversal on the chart. Charts can be off by a few dollars, but ultimately, if you're in the right zone, you can pick up a phenomenal trade. So gap fill zone is your next big area of support if you take out this upsloping trend line, and it's looking likely that you do. If we see continued downside pressure tomorrow, that trend line is going to be major. The selling could start, in full force if you break certain key levels again on the indexes and whatnot. I haven't touched on AT&T, but this is one that we've been holding now, and it was made clear that we would hold it for several months. And one of the reasons we've been holding this for a few months now is during the Archegos. Let's just go back to the weekly chart. So during the Archegos collapse, so this is back in, we've been holding it for now almost what are we? Here we go. So this is the Archegos collapse. We picked it up somewhere in here in November, early November. So this is when the Archegos collapse happened. A hedge fund went under, and this thing got caught in basically a one-day move that was something that most people had never seen before. It was just massive fire sale liquidation, margin call. And then from there on in, the stock just started declining. And we ended up picking some up, and we've been holding it now since November of last year. But one of the reasons we ended up picking this one up, well, not only was it into massive levels of support, this stock has consistent revenue in the sense that its product is needed. People are not going to live without their cell phones. It's one of those things that they're always going to continue to pay for, or else they get cut off. And a lot of people need their cell phones these days. So not only is AT&T a solid company in terms of their cash flow, their balance sheet, the metrics there, certainly they're not a growth stock anymore, but you can consistently project how much they're going to earn, and it's an easy company to work with since their services are on the needs of people's priority list. And what you can see here is we did have an initial rally in AT&T. We didn't sell into that rally because there was talks about a spin-off of their company, was a discovery company. So by them spinning off their Discovery Media company and letting it fall to the umbrella of Warner Brothers, it now is, we're in a position to greatly benefit from that spin-off. So since we're a longer term shareholder of the company, we are now going to receive 0.33 shares for every 1 share of AT&T that we hold. So we hold about 1,275 AT&T shares here at Trading Capital. So we're going to get an additional 333 shares. Let's just call it 300 for easy math. But we're going to get about just over 300 shares in the new spin-off company of Discovery and Warner Brothers. And currently, if we flip to the Discovery chart, let's just search Discovery. The beautiful thing about these stocks is that since we get about over 300 shares in Discovery, even if Discovery falls to test this pivot low here at $21, even if it falls to $20 and makes a new significant low on the charts or comes to test this region, $20 times 300 something shares, that's over 6,000 US that we're going to bank in Q2 just in new shares. Just by simply benefiting from holding AT&T long term, we're getting an additional 330 shares in basically a new company. Well, a company that exists, but 2 companies amalgamating to combine their assets and potentially make a stronger company. So that's a nice, $6,000 at the current levels. If it stays at these $24 prices, that's around 8,000 that we're going to get in extra shares that will greatly, significantly push up the benefit of owning AT&T. Not only do they pay a dividend as well, but it's going to be a nice added bonus when the deal and the amalgamation, the merger of the 2 companies close, I believe sometime mid to late Q2. So we're in Q2, so sometime in a couple months we can expect those shares to be in our account, and it would greatly be a nice added bonus of potentially somewhere in the range of 6,000 to 8,000. Now, just looking at AT&T on a daily basis, notice here you had this initial breakout move. If you flip, you broke above the 200, couldn't hold that price action, had a massive sell-off. You've been flagging down in this descending bearish wedge ever since, and it looks like you've had a short-term breakout out of this falling wedge pattern. So now the question is, we're lingering with the 50-day moving average, and we've actually closed above it and couldn't confirm. Now we're closing right on it. So it's going to be a big test whether we can hold this level of support. You are in somewhat of a bullish consolidation, so you could very likely go test the 200-day moving average and eventually higher. And the nice thing about owning these companies is that they're not as volatile to the downside since they're already beaten down from the highs significantly. And you can see that the long-term pattern, even after the 2018 tightening cycle, even after the COVID bottom here, even after the September 2015 economic hiccup, basically you're near the lows on the chart. So the risk to reward favors the upside. It certainly favors the upside. So just by, again, this key ad on Tesla shows you just by inching in at key technical levels and being patient, letting the price come to you, shows you how you can accumulate shorts and longs to greatly benefit you for when the market does turn. You know, a wise investor once told me, one of my trading coaches, the money is always made on the turn. I'll say that again. The money is always made on the turn of the market. And too many people try chasing, but it's the turn. It's that initial pull off, you know, 1 to 2 days of selling, or that initial 1 to 2 days of bounce that often make you the most money. And that's why I love technical analysis, because you can get a great read on human emotion through the movement of price action. So stay tuned for some more alerts. We potentially may start looking for you know, other short opportunities if there is some sort of a bounce tomorrow. We'll just have to wait and find out. But essentially, today the Nasdaq logged the biggest one-day drop in a month. So when the selling starts, the selling can really start. And we still didn't see really convincing volume across the indexes today. It's still relatively light when you take into account the average of roughly 13.5 billion shares in the markets traded for the last 21 days. So stay tuned for more price action. We'll have to be patient, but I do think we could be at an inflection point that could send the markets much lower if the fear starts kicking